So welcome to day 2 of our bootcamp. And I said that, in today's class, we're going to be talking about building bias. Yesterday, we discussed the foundation of market structure and then the foundation to Forex. You get how to be able to actively trade market structure and what you should know concerning rules guiding market structure. Okay, what a break of structure is, characteristics of a bullish market structure, characteristics of a bearish market structure. In today's class, we're going to now be talking about how to build our bias. Now, bias are very much important. Okay, there are four major things that make up a good trader. All right, four things that make up a good trader, and I hope you're with your notes for today's class. Like I said, today we're going to be diving that right into the main things, right? So there are four major things that makes a let me use great trader, right? And that makes a great trader. Number one of those things is bias. Number two is points of interest. Number three is precision in execution. Number four, above all, is risk management, psychology, and the risk management. Now, let me just call it risk management and psychology. All right. So what I just did. So now these are the major things that makes up a good trader. Now, bias is very much important because one of the things that bias will do for you is to tell you whether you should be looking for buying opportunities or if you want to be looking for selling opportunities. It is one thing to call bias. And you see many persons, if you're a trader, you've been trading for some time, you will agree with me that majority of the time bias is not your problem. All right. Forgive my spelling and execution here. So you will agree with me that majority of the time bias is not your problem when it comes to trading, right? That you don't necessarily have issues with bias. You can easily tell that, okay, market should buy and market will buy. You can easily tell that market will sell and market will sell. But the issue you always have is now identifying the points of interest where you should wait to be able to join this particular trade. Okay, okay, fine, market is going to buy. Where do I buy from? All right. Or where do I sell from? Market is going to sell. Another issue is now precision in execution, which is the ability for you to be able to take the trade properly and make money out of that bias you called. Because there's no point having to share bias. I'm bullish, I'm bullish. Oh, such a good trade. The trade went my way and all those things. And you're not making money from it. Okay? So bias is important. Points of interest, which is now those particular zones. McDouglas wrote a book and called it Trading in the Zones. All right? Those zones where you want that price to come into so you can participate in the bias that you've actually called. Then precision in execution. This is now where entry is coming. Okay, fine. Price has come into your point of interest. Some other persons, they execute even outside of the point of interest. Some people have issues with identifying proper point of interest. Some other persons have issues with now, even when price come into the point of interest, the precision in execution. You see that you're entering too early and price will stop you out, or you're entering too late and price will stop you out, or you're even missing out on the trade, or any other thing again that you could talk about. And then the fourth one is now risk management and psychology. All right, this is now it. So you would realize that the reason why many traders run in cycles for long is not necessarily because of bias, but you see it's because of number 2 and 3. You see this number 2 and 3, they can keep you running for long. They can make you jump from one strategy to another strategy because you're looking for the holy grail. Oh, how is this guy catching his trade? This guy caught 1 to 20 risks reward. I want to go and learn. What you're trying to understand there is not necessarily the bias, is you're trying to understand why he marked out that point of interest and how he was able to execute. Are you serious? This guy trades so and so concept. Let me go and learn. Okay, this guy uses trend line. This guy uses liquidity. This guy uses key levels. This guy uses this. This guy uses that, and the rest of all those things. Okay, So you realize that majority of the time you are trying to pursue number two and number three. And it will interest you to know that number two and number three, though very, very, very much important, all right, they don't contribute majorly to the success in trading. If you read this book called the 80-20 Principle, one of the things you realize that what contributes to the 80% of the success you see in your life are just the 20% of the things you do. And in this trading thing, you see that 20% of the things which matter so much well that contributes 18% is the risk management and psychology. No strategy is a wasted strategy. No matter in short, as long as you have an edge over the market, that in the statistical or in the long run, the statistical probability will be in your favor. There is no strategy that is bad. And all you have to understand is how to just use that edge in your favor in the long run. You don't have to be jumping from majority of you now, maybe why you are here in this boot camp is to get answers to, okay, I'll call bias, but then the entry, so you're still studying and studying and studying and studying, and the studying is not ending. Look, let me tell you one truth is that you have to find rest. Look for a method that works best with you and stay with it. Once you stay with it long enough, once you stay with it, just like hanging around the barber shop long enough, sooner than later you are going to get a haircut. Once you stay with it long enough, it will break out to you. That is just the truth. Okay. And I'll be teaching you how I use my method and what my methods are when it comes to identifying points of interest and precision in execution. At least I've been sharing some of all those things with you guys in the free Telegram channel. Maybe later on in the future, I'll consider if there will be a need for me to want to do anything signals in the free Telegram channel. But for now, no. All right. The best I can give you is just points of interest. So in today's class, we're going to be talking about bias. Then after bias, from tomorrow, we'll be talking about points of interest. Then on Thursday, we'll be talking about precision in execution. On Friday, we're going to be talking about putting it all together, risk management and psychology, and your ability to, utilize what I'm going to be teaching you here to make some profit. Okay, so let's dive right into what we have here. So building bias. This is what we're trying to talk about today, right? How we can build bias effectively. And in that building bias, we're going to be looking at the monthly daily ranges, which is the MDR. I call it the MDR, monthly daily ranges, and the daily trading ranges. Two of them come or works hand in hand in building a bias. And like I said, I don't want to bombard you with so much information. So the law of diminishing return will not begin to happen. You know that law of diminishing return. You've learned so much that then the informations are now too much in your head and you're now beginning to forget so many things. So it is best to always just give it to you in bits so that as you begin to study, every single thing is going to, come together and then make much more sense. So in today building bias, based on my system, I focus majorly on the monthly daily ranges and the daily trading ranges. Now, what I'll be teaching you on the monthly daily ranges or the monthly daily range concept, all right, which I use. I can proudly say that I'm the founder of that concept, okay? But the concept is based on something that probably is already out there, which you can use, but this came as a result of my personal studies and, the data I've gathered from the market. Now, what I'm going to be teaching you, if you already have a different way of approaching the monthly time frame before, it's going to be something maybe somehow new to you, but then this is it for me and it works very well. And we're going to take so many examples today, all right, regarding bias building from the monthly time frame to the daily time frame. So get your note and follow carefully. All right, follow carefully. So monthly daily ranges. What are monthly daily ranges? The monthly daily range, which is the MDR, I call it the MDR, refers to the most recent swing point or price range established in the monthly time frame. The emphasis here for me is this. This is the emphasis here for me. Most recent swing point or price range. That is the emphasis for my monthly daily range concept. All right. That is the main thing that matters, that it is the most recent swing point. When I am marking my monthly daily range, I don't care what price has said or where price is coming from. In short, on the monthly time frame, I limit the scope of my search. And that is where I try to, and then just looking at what the name is, monthly time frame, daily range, that this is the ranges I'm looking to deal with over the next period of time when looking for trading opportunities. So when I go to the monthly time frame, I'm not interested whether the market is trending up or is trending down. That is just me. I'm not a swing trader, I'm an intraday trader. And even if I want to be a swing trader, that I will hold trades for 2 to 3 weeks. I don't need to know the direction of the monthly time frame. Now, what I'm about to say, it may be conflicting with the normal thing that you must have had before when it comes to understanding monthly time frame range. Some person will tell you based on top-down analysis, you want to understand the flow from the monthly time frame and trade in line with all those things. Then I will show you why I'm pretty much not interested in all those information and how I use the monthly time frame and the way I use it. So the purpose of using the monthly time frame daily ranges is to frame my higher time frame structure and context for trading decision. And this is how I apply it. I zoom out and mark most recent swing highs and lows. Then I observe the zone of current price structure, which is the premium or the discount zones. Okay, so we're going to go into the chart and we're going to take examples on that. Okay, so remember I said that the interest is on the most recent swing point. Then when it now comes, okay, so into the charts for chart examples, then let me just talk about the daily trading ranges. Then we'll go into the chart. Or before we come back into the daily trading ranges, let's go into the monthly daily ranges and let's study monthly daily ranges, okay? Let's go study the monthly daily ranges. So what we have here, and I'm going to use as many assets as possible. So now this is GBP/JPY monthly time frame. Now, when I come to the monthly time frame, this is how I start my analysis. When I come to the monthly time frame, this is what I'm interested in. Those of you who trade based on monthly time frame structural flow, we begin to say stuff like this. Price created higher highs, higher lows, higher highs, and then we're expecting some reaction, maybe to resume some more bullish price action, right? And then maybe you're seeing some SMC downtrend retracement, waiting for that perfect break to now start buying to the upside. But will you agree with me that since October last year till this month, look at just the range in the market has been doing? Now, somebody who would always look at the monthly time frame and say that I want to determine price action from the monthly time frame, you would realize that you will miss out on, you will get confused easily with the range like this because you actually need that monthly time frame range to play. And now this is why I focus on the monthly dealing range. I focus on it simply because, do you understand the power? It was in the course of a study, one of the days, and I realized that, do you understand the power of one monthly candlestick? Like, I mean, in one monthly candlestick, there are 25 trading days minus weekends now. So if you trade synthetic indices, there are 31 or 30, depending on the number of the months, right? Trading days. So, but then minus the weekends, we have about 25 to 26 trading days in just one monthly time frame candle. Now, do you know how many trading opportunities we got in the month of May on GBP/JPY alone? We got plenty opportunities in the month of May. And all those opportunities we were able to catch on the 1 hour time frame was just inside this one candle. So if that one candle can be that powerful, why don't I understand the anatomy of a monthly dealing range than trying to confuse myself, knowing whether the market is trending or is not trending or is retracing or is not retracing, all those kind of stuff. So I try to limit the range. I try to limit the range of, this is what I'm dealing with. Let me go to the lower time. I'm an intraday trader. Many of you are not swing traders. That is not the truth, because you cannot swing trade. Yes, prop firm offers swing trading, but many of you that trade even prop firms or personal accounts don't trade it with the idea of swinging. Many of you on this call now are day traders looking to make those daily 1 to 3 risks to reward, or 1 to 5 risks to reward, or 1 to 7, or whatever risks to reward it is that you used to catch. Okay, so if that be the case, what then? Why are you now treating it as though you are looking to swing a trade and then you are missing out on many opportunities? So when I want to trade the market, this is how I approach it. I come to the monthly time frame and I'm looking at, okay, what is that most recent swing point? If you cannot see it clear on the candlestick chart, you turn it to the line chart. As it stands, the most recent swing point here that I'm very much interested is these highs and these lows. Ideally, I would have marked out these lows and this potential point forming here now. But you know why I will not mark this out? Because this guys has not closed yet. This candle is still open. All right. Ah, no, sorry about that. Sorry, because you can see that this candle is still open. So we've not closed. I work with the closure of a particular candle. So this is the candle close we have here, or a structural point close and a structural point close we have here. So that is my most recent swing point that I can spot from this. That is the most recent swing point. And I'm interested in, and when drawing the range, obviously I draw from weeks to weeks. So I am interested in that range, going down to the lower time frame to identify what price is doing within that range to make out my informed trading decisions. I don't care that, okay, price is bullish, we're coming from here, we're coming from there. No, a whole lot of information is here. Now, you have this range that we are dealing with from the month of October till this is June. Now, that is how many months? October to October is 12 months. So when you remove October, September, August, July, minus 4 months. All right. So this is about 8 months of trading within this particular range. So in the past 8 months, price has not gone above these highs and price has not gone below these lows in the past 8 months. So why stress myself with, okay, what is price doing here when I can just limit my scope of search to just this range and just this range, go down to the lower time frame and see how I can utilize trading opportunities within those zones. Now, in this past 8 months, if you do 25 times 8, you will see how many trading days you have there. Now, in those trading days, you can now see in the 1 hour time frame or in the 15 minutes time frame how many good trading opportunities you would have had. So identifying daily ranges for me matters so much. So when I want to identify my daily range for my analysis, I come to the monthly time frame. I said, okay, what is that range that I'm dealing with at the moment? And as it stands, this highs is my monthly daily range high. This low, I'll prefer to use this low right here now, right? Is my monthly daily range low. And whenever I'm defining my monthly daily range, I always need that 50% fibs, and I will explain why. I'm using the Gann box here. I just had to delete other settings from the Gann box. And in the Gann box, I'm interested in just the 0, the 100, and then the 50 fibs of that Gann box. All right. So I want to see the highs, the lows of that range, and then the 50% of that range. It is very much important. I will explain when we now start talking about the daily trading ranges. Okay. So this is it. When I want to define, when I come to monthly time frame, the first thing I want to look at for is what is my MDR on the monthly time frame? What is that monthly dealing range? And I mark out from this most recent swing highs to this most recent swing lows, indicating also the 50% of that particular range. Let's go to another asset. Let's see GBP USD. For those of you that trade GU, we can look at GBP USD and you see that also on GBP USD, we have this. If you ask me what is that most recent swing highs, now before we got this new range, now I will teach you later on how to train after that monthly daily range has broken. What do you do next? This would have been my most recent swing highs. Just these highs to these lows. That is my most recent swing point. So I am more interested in how to engage with price action within this particular range. That is all my interest. That is all I want to focus on. How do I utilize price action with this particular range? So I open a chart. I go to the monthly time frame when trying to conduct an analysis, and the first thing I want to spot is, let's say USD card now. I open USD card, monthly time frame. The only thing I want to identify is most recent lows, which was this lows, and most recent highs, which was this highs. After this, I've gone down to the lower time frame to begin to do other work, which I'm going to show you when it comes to building bias. All right. After identifying these highs and after identifying these lows, the next thing I do is to go down to the lower time frame on the daily time frame precisely to now begin to do some other works there to now make an informed trading decision regarding my bias building. So that is how I use my monthly daily range. Any asset, just look for that most recent swing point. Don't get it confused. Don't get it twisted. It can be very simple to spot. It's not difficult to spot. Let's use Euro USD now as another example. In this particular case, before we got this break, I don't want to get things twisted now regarding a break of a zone, but I'll teach about that in this class. So, but then this would have been the most recent range that I would have been focusing on. All right. I don't care what price has been doing in the past. What other asset again can you think of? Let's say you were looking at AUD card, the same thing, AUD card. What is that most recent range? If it is confusing for you, you turn to line chart, you will see it clearly. Line chart's most recent range is this range to this range. Now, somebody will be looking to mark out because of the candlestick. You want to mark out from these highs. That is too far away. And the beautiful thing about monthly daily range, now, like I said, is weeks to weeks, right? So we'll mark out from this week here, which is this week above there, all the way to this week below here, right? Now, the beautiful thing about monthly daily range is this. The smaller the range, the better for you. That is why we always want to focus on the most recent range. And in a range, you might have up to 4 monthly candles there. That is about 100 trading days. Okay. So you can imagine all the opportunities that will present to you in 100 days. That's about 3 months or 4 months, right? So in this particular point, I would not be interested in marking out from these highs because you can get lost. If I were to mark from here to here, for example, I would not be interested in marking all the way from these highs to these lows. No, that is not how I identify my swing point. I identify no matter how little the turn is, this would have been the range I'll mark. After the break, this would have been that new range. After the break, this would have been that new range. And after this break, this would have been this highs and this lows range. Now we broke below. Our range has changed from these highs to these lows. So we continue trading within this range until either the highs or the lows get disrespected. That is one thing about the monthly daily range. You will always see price within that daily range until either the highs or the lows get disrespected. And until that happens, you will see price within that range. Now, how do you now utilize that information to be able to build a bias? Let's now talk about um the daily time frame, daily range, right? So let's talk about daily time frame and how to use them effectively, all right? So this is now for the daily time frame. So you now have the daily trading ranges. Like I said, after in building bias, after we've considered the monthly daily ranges, the next thing we want to look at is the daily trading ranges, right? So now in the daily trading ranges, it refers to the most recent structural point established on the daily time frame, and it is best used for determining directional bias. Purpose of this is that it helps us to identify or to have a defined bias which will guide us to make informed trading decisions. Applications: zoom out and mark out most recent swing highs and lows. Check out for higher highs, higher lows in a bullish case, or lower highs and lower lows in a bearish case. Define current trading ranges, because it is in that trading ranges, that's why it's called daily trading ranges. The difference between a dealing range is that it is called monthly dealing range because this is the range we are looking to deal with in terms of building our bias. Then when we come to the daily time frame, we call it a trading range because this is the range we are looking to take our trades in from the lower time frame. You see the two difference? The monthly time frame, we're identifying the dealing range. So we're trying to limit our scope to that range of such where we're going to take our trades, or I say our trades. Then the daily time frame is called the daily trading range, where we're going to look to go down on the lower time frame to begin to take our trades and execute, all right, based on our bias. So having said that, let's now go into the chart for more examples. And then we'll now begin some chart studies. Regarding that, okay? So when you come to, let me use the AUD card we can see here. Now, this is a rule I would need you guys to pay close attention to. Just a moment. So this is it. Just a moment. Just a moment. Let me write this out for you guys here, so you will take note of it. Oh, sorry. Didn't copy that one. All right. Oh, I'll need to break this down, okay? Uh, so we don't need this. Just a moment, okay? Sorry, I should have done this. I should have added this to this thing. I'll still need to reduce this because it's too big. All right, so let's see if it will come here now. Good. So this is how to now approach it when building the bias. This is what exactly you should do when building the bias. The first thing you want to do is to identify your daily range from the monthly time frame, which is the last obvious open swing point. We consider weeks to weeks when drawing it. And I told you that last swing point from your swing high to your swing low, right? Then we're not interested in going down to the weekly time frame. Just leave this weekly time frame out of it. All right, we don't use the weekly time frame in this. All we're interested in, all right, is the discount zone is usually below the 50% fibs of the monthly daily range, while the premium zone is 50% monthly daily range, all right, above the 50% of the monthly daily range. And I will show you guys something on that just shortly. Then after that, you want to scale down to the daily time frame, continue to trade. Now, this is now where the emphasis is going to be on. Scale down to the daily time frame, continue to trade in the direction of the daily structure until a counter break of structure. If a counter break presents, first target should be the 50% fibs of the monthly daily range. Now, this is what I mean. You know, we are building bias. Monthly daily range, our swing high is from these highs, weeks to this low on AUD card, right? Anything above here is the premium zone. Anything above this 50% fibs of the monthly daily range is termed the premium zone. Anything below it is termed the discount zone. So we know that once we see price here, price is at discount. Once we see price here, price is at premium. You now scale down to the daily time frame and continue to trade in the direction of the daily structure until a counter break of structure. If a counter break of structure presents, take that trade. Let's say you go down to the daily time frame and the structure is bullish. Continue to trade in that direction until you see a daily break. Once you see a daily break, your first target is this 50% levels and beyond until you also see a counter structure. And we're going to go down to the daily time frame now to begin to see that. Okay? So let me just copy all this and keep it because we use it in other assets when studying for other assets. Okay? So let's go right into the chart. Now, this is the daily time frame. What can you see here? The first thing you will notice here is this, is that price is currently at premium zone. Current price is above 50% and is currently at premium zone. Then you go down to the daily time frame. Now, we want to continue trading in the direction of the daily time frame until a counter break. Now, from here, you can spot out that the direction of the market is simple. We are bearish. Turning to line chart, you will see it better. Price came here, was giving you higher highs, higher lows. Remember the foundation of our structure yesterday. Higher highs, higher lows, higher highs. And you know, we can call this a higher low because it created a new higher high. This was where the break of structure happened, not here. You know, some persons will look at this as a break of structure. That was not a break of structure. I told you in the class yesterday that we consider a break of structure only after a structural low has been invalidated in a bullish case. So in a bullish case, we always want to see the lows respected. Once we see price disrespect that particular low, what do you expect in the market? A break of structure, and you see price start going down. So you now created lower lows, lower highs, lower lows. Now you can see the lower highs. First target should be where? The 50% fibs, and we will most likely continue seeing that until we see a counter break to now change our bias to bullish. So as it stands now, our bias is bearish because we can see that we've already gotten this break of structure to the downside and price is respecting these lower lows, lower highs, and lower lows. So if you are to draw your trading range, where will be your trading range? The most recent range, which will be these highs and these lows. So when you go down to the lower time frame, turning using the candlestick, the wicks now, right? When you go down to the lower time frame, this is the zone on the 4 hours time frame, for example, where you want to identify those points of interest, where you can now take your trades to start going down. All right, so it has limited your points of interest such not to be interested in anything you are seeing above here. Because if price should come there, we might most likely have a break on the daily time frame that will take price all the way to the upside. It's as simple as that. So a trading range helps us limit our scope of search. Now, let's take this more into some assets and then we'll do it with a backtesting method. So if there are assets you will want me to use this to, or you want us to study on, just drop them in the chat box and we're going to use them. All right. So let's start with GBP USD. If there are assets you would like me to use, whether it's gold or any asset you can think of, drop them in the chat box and we're going to look at that. So let's start with GBP USD. And I'll be marking out any random zone. Let it not look as though any random zone. I'll just cut and I'm not planning anywhere at all. Let's say, let's study from, where do we study from now? All right, let's study from here. Sorry, just a water break. So let's study from here now, using this replay tool. You come to the monthly time frame. What do you want to identify? Most recent daily range, which is going to span from that highs to this lows. That is our swing point. Now, after that, you want to go down to the daily time frame. Remember, anything above the 50% is what? Your premium level. Anything below the 50% is your discount level. The next thing you want to find yourself doing is this. Continue trading in the direction of the daily time frame structure until you see a break. As it stands, what is our daily time frame structure telling us here now? That this is bullish because we have higher highs, higher lows, and a higher high. So we want to see price continue trading with this. If they give us a break here, then we know that we are now bearish. We can now start seeing some bearish price movement. Okay, so we are on a study of bias. I'm not going to be going below the daily time frame. We'll just stay on the daily time frame for the study of bias. Tomorrow we'll now start talking about entries and points of interest and all those things. So we'll just be studying how we can call out for bias. So now our bias on GBP USD is what? Is bullish. All we want to see is bullish price action. So we are looking for buys. Let's see how we would have been able to utilize that. And can you see what did we get? Did we get the buys? Was the daily range respected? Lows and highs, our daily range, right? And did you get that buys? Price came all the way below and it got the remaining days of the buy, right? Our daily structure still remains bullish. Now our daily trading range will span from these lows all the way to these highs. We are still looking for buys until we see a counter break, which is a break of structure here. So the next thing again you want to watch is just look for only pure buying opportunities. Do we get any buying opportunities? A new buying opportunity. Now see something here. We got a new buy because price created a new higher highs. You know, we have higher lows, higher highs, higher lows, and this high came below this. So this is a new higher high. Automatically, our trading range is going to span from here all the way to these highs. But you can see now, what do we have here? A break of structure. Because ideally, we shouldn't see price close below this range if at all we want to go bullish. So now, our bias is no longer bullish. Our bias is now bearish. So I don't want to be looking out for bullish opportunities again. Some persons might be saying, this is internal liquidity, price came to capture internal liquidity and all those things. It's not my business. Like I told you guys yesterday, once it comes to the daily time frame, I don't care internal liquidity or no internal liquidity. I trade pure structure on the daily time frame. I'm a firm believer that every time frame has a story to tell, and the daily time frame is telling me stories for directional bias. And I follow strictly what the structure says. If they stop me out, no problem. I quickly change my bias. Maybe like this now that we are bearish and they happen to stop me out on these highs. No problem. I quickly change my bias and then I'm looking for selling opportunities only. Okay. So having said that, I want to sell this market and first target will be this 50% fibs. All right. And beyond. So we'll continue selling until we see a counter break on the daily time frame. Then our bias can change again. So as it stands, what is our bias now? Our bias is bearish. Let's see what price did over the remaining days. Did we get the bearish move? So you see that we're still trading within this daily range. All right. You know, after that break, this is going to be our trading highs, trading range highs and trading range lows. So we are still within that range. Price has been ranging within that particular range. Let's see what price is going to do. Did we sell or did we buy? Sorry, just a moment. All right. Did we sell or did we buy? Can you see that sells? So automatically our selling bias has resumed. Now, or has continued rather. This was that break. So now our new trading range is going to span from these new lows to these new highs. All right. I taught you guys market structure yesterday. So we want to continue selling the market until we see a counter break. If no counter break of structure within this our monthly dealing range, you have no business looking for buys. That is just the truth. Your bias should remain bearish. So let's see what price gave to us here again. Did we get a break or a new low? Good. Now look at this. You now have a break of structure. All right. This was the previous highs. Price has disrespected it. Now our bias is no longer bearish. You can see the instant switch of bias just within this zone. You got a break here, giving us the selling bias, and an instant break again, giving us a bullish bias. Now our bias is bullish. All we want to look out for is bullish opportunities. Trading ranges will span from these lows, all right, to the highs where price is. And you want to follow the daily time frame structure until you see a counter break. So what did we get again in the market? Did we get a new highs formed? Let's see. We are still respecting this structure. Good. A break now. How many breaks within one zone? About 3 breaks now, right? No problems. It's not an issue. All right. Definitely on the lower time frame, you should have been able to cut 1 or 2 trades here before you get this break of structure. After all, you get that this was days of retracement. So in this retracement move, you could have gotten about 2 or 3, 1 to 3 rigs to reward trades. But let's continue. Now our bias is bearish. So we are looking for only bearish opportunities. And you can see how the bearish opportunities continued. What did we have here now? After this break, we got a lower low, a lower high, and now a new lower low. So we want to continue selling this market unless, sorry about this, I think my network is having just some issues. I think it should be clear now. Yeah. So you can see we've already gotten this break of structure where they disrespected the previous range, which is this lows, and we want to continue trading in that direction. And remember what I told you guys, no matter how little that structural point is, as long as it is on the daily time frame, it means so much to me. All right. So now we are bearish. If we get a candlestick close above here, and my bias is now bullish, no longer bearish, but I will be looking from these highs to these lows for bearish opportunities. Let's see what price did here on the GBP USD. Did we get that? Good. The next day gave us a break. Instantly buying opportunities. That is why you can see me. I will tell you guys, I'm looking out for buying opportunities. Instantly, I'm always looking. The next thing you just see me, I'm changing my bias to a bearish opportunity. Now, the next thing you can see here is what did we get? A bullish opportunity in the market, right? We continue trading in direction of the bullish market after this particular break. Our new daily trading range now range from these highs to these lows, from these highs to these lows. And can you see how that daily time frame structure, if you turn to line chart, is still being respected? All right. Each of those highs and those lows are still being respected. After this break, higher highs, higher lows, higher highs, higher lows. Did it give us a new higher high? Let's see. Let's zoom in better. So we cannot call this a higher high, right? Because price did not close below the previous higher highs. So we can also not call this a higher low, because what validates a higher low is a previous higher high. What did you now get? Price went ahead to give us that new higher high. So based on structure, our trading range is going to now span from these lows to the new highs that was created, then these lows to a new high. And like I said, no matter how small it is, this is going to be my next trading range. I don't care, because if price come here, this is already a break of structure and I should see it take price to the downside. That's just how I'm going to react to price, okay? So turning back to candlestick charts, that's what we're going to get. Did we see price react from there and respect it beautifully? Because, somebody else now will be waiting for a deep retracement. There is an imbalance here. This should be a deep retracement, capture imbalance, and start trading to the upside. No, I don't trade that. I follow the most recent structural points. No matter how little it is not insignificant. It speaks volume to me. In that particular case, you see these lows, these highs, that will be my trading range of which price came there to create a new highs for us. Now, I'm also going to still maintain this new structural point until we break. If we don't break above below it, we should still see more bullish price action. That is how I trade, okay? So let's see what price did in the other days. Can you see it? Did they break below it? No. They respected that structural point to give you a new structural point. What is your new bias? We are still bullish. No bearish price action until we see price close below this low. So my new trading range is also going to span from where? From these lows to these highs. I want to continue looking for buys until I see a daily break of structure below that lows. Did we get a daily break? No. All right, price gave you these lows, these highs, came all the way here and cleared here on the lower time frame. This is already a sweep of liquidity before we now went to have this break of structure. Now, see this break of structure. The last most significant lows was this lows and these highs. This did not close above this based on candlestick body. And what did you get? Price came here to break structure. So automatically, what do I want to be looking out for? Selling opportunities. My bias is now what? Is bearish. I'm no longer looking for buys. Did we sell? Yes. Can you still see how the selling opportunities are respecting the selling ranges? And we should continue respecting the range like that until we see a break. So I want to continue selling this market until I see a break here. If there is no break here, I should continue selling the market structure, sell all the way to the downside. And we've gotten that break. Sorry. We've gotten that break, and you can see how that break led to bullish price actions, okay? So let's take another example with another asset. Let's look at which asset is going to present to us here now. All right, let's use the USDJPY since we have, do I have a markup on this? Okay, no, I don't have a markup on this. All right, so on the USDJPY, let's study previous price actions. Where do I cut from now? Where do I cut from? Where do I cut from? All right, fine. Let me cut from here. All right, so our trading range is going to span from monthly daily range from these lows all the way to these highs now, right? Coming down to the daily time frame, we want to trade in the direction of the daily time frame until we see a counter break. So, and the daily time frame structure you can see here, we already have, if you zoom in properly, price gave you higher highs, higher lows, higher highs, higher lows, and a little higher high here. If you turn to line chart, you will see it. All right. If I should zoom in better, you're going to see it there. You can see it higher highs, higher low, higher highs. I don't care how small that is. If price, maybe the next daily candle happens to come and close below this structural point, this already is a daily break for me. Like I told you guys, no matter how little, that already is a daily break for me. All right. So let's see what the next daily candle did. We are still bullish. You can see how we are still respecting that particular range. We are still bullish. Then we've created a new, did we create a new range? Good. Can you now see how, no matter how little that structural point was, it was powerful enough to even respect price to go all the way to the upside. So we are still trading in the direction of the daily time frame until we see a counter break. So if the next candle closes bearish, I'll be looking for selling opportunities. If not, I want to respect the bullish price action that price is giving to me here. All right. And now we've gotten that break. Can you see the break that presented? Now, this was where the break presented. All right. So our monthly daily range will be all the way to this point, right? So you can see where that daily break presented. Do you remember the rule I told you guys? I told you guys, if you remember, that we want to continue to trade in the direction of the daily time frame structure until a counter break of structure. If a counter break presents, first target from this counter break should be 50% fibs of the monthly daily range. I showed you guys that at the very beginning, right? So now we've gotten that counter break from the daily structures that we've been getting. Where is our 50% fibs? Here, all the way to the downside. So we should actually see price sell from here all the way to the downside. That's enough. You might see this as something not really significant, but that is a very big deal for me because the daily time frame tells a whole lot of story. I want to see, let's see if we can get price, get all the way to this 50%. Then after on, we can now study the interactions of price below there. So did we get to the 50%? Can you see that? And when we came to the 50%, can you see how they were respecting all the structural points, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, no counter break until we came all the way to the down point. As simple as that. Now, how will I trade this market? I want to continue trading this market until I see a counter break to the upside. My bias remains bearish on this particular asset. So I am still looking for selling opportunities. Where would be my most recent range? These highs and these lows. I'm still looking for selling opportunities until I see a counter break. For a counter break to present, that means they will have to come all the way up here to break structure. So, but let's study what price action did in the following days. Can you see this? Now a new low has been formed. Look at this. If it turns to candlestick chart, yesterday class, I told you guys that I use candlestick so much when it comes to identifying structures. I don't use wicks. So if it turns to, and that is because candlesticks follow the line chart. You see here, we had a new low created here. So we now have lower lows, lower highs, lower lows. If price breaks this, then I can look for bullish opportunities. But since we are still respecting these bearish opportunities, I am bearish. My bias remains bearish. If they close here, this is not a break. Like I taught you guys in market structure, you want to identify that true ranges in your structural time frame. I mean, your structural point. Lower lows, lower highs. This is a lower low. All these other things here, internal liquidity. So you don't see that, oh, price broke this. Now we are now bullish. No, we are not yet bullish. The only time we say that are bullish is after price has closed this above this particular highs. Then we can say you are bullish. So let's see what price did in the following days. Can you see a new structural point? So imagine you saying that you're bullish here. It's wrong because this is the original highs that was formed here. Okay? Turning to line charts, zooming in better, you will see all the structural interactions there. Can you see this? Lows, lower high, a new lower low because they closed below this previous low, cleared all this internal liquidity, now a new lower high and a new lower low. So I am still bearish. This is my trading range until I see a counter break. That counter break will mean that price should close above this particular highs, right? So let's see what price is going to do right there. Are we going to resume our bearish price action or? Okay, you can see. Sorry for that network interruption. All right. So you can see that we now have a new range. Lower lows, lower highs, lower low, lower highs, lower low. And like I told you guys, you have no business looking for buys because our bias is still bearish. So I am still maintaining a bearish bias from these highs to these lows until I see a counter break, without which you have no business looking for buys. So let's see if we are going to get any of all those counter break structure. Now we've gotten a break. All right. So this is now a defined break. Having gotten this break, which is a counter break, where do you want to take it to? First target is 50% of that monthly daily range, because our monthly daily range is now going to span, is still from that highs to these lows, the most recent daily range. We should see this daily break lead us at least to the 50% of the fibs, monthly daily range fibs, and beyond until we now see a counter break to want to sell. So let's see how far this went. Did we get up to the 50%? Sorry, let me just play. And that was it. Can you see it? And even when you got to the 50%, no doubt, okay, yes. Remember, we are supposed to get to the 50%, but we got a break here. What would I have done? I would have actually changed my bias from bullish to bearish until we see this new break. Then I will go bullish again. But that 50% is always the easiest target once you see stuff like this. And that is why I love that monthly range concept. Once you identify that monthly range, you can have easy targets. That 50% is an easy target after a counter break. So imagine trying to wait for when the monthly time frame has given you all you want to see before you start identifying your bias. You will wound yourself. You will probably even wait for long and start trading what you shouldn't be trading. You might be seeing this break as a break, whereas the original structure is bearish. Now, what you should actually be seeing as a break of structure, you'll be seeing it as internal liquidity, and you'll be getting yourself wounded. All right? So in that particular case, you can see this how price reacted. And you can see how even after this break here again, can you see how all those little candles were respected beautifully, right? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and so on and so forth. Now, you might not be able to trade this on the lower time frame, which I would not advise, trading this type of structure on the lower time frame. And like I told you guys yesterday, I believe that every single time frame has a story to tell. Once it comes to the daily time frame, follow the daily time frame structure. Whatever it is telling you, follow that particular structure. Okay. So we just took two examples, which was on the USD card and on the USD JPY. So let's take, okay, I'm seeing gold here. Let's now take one more example on gold, and then we'll call it a day. All right, we'll call it a day. You obviously will not learn every single thing I know in 5 days bootcamp, but I'm going to teach you every single thing I know without having to hold back. That is just a promise. It's the truth, okay? And there is nothing else I'm holding back for you guys when it comes to building bias. If you should ask and interact with my students, exactly what I'm teaching you here is what I taught them in the academy. So, and like I said, you have access to the video after the bootcamp. All right, so you stay tuned. After the bootcamp, all the videos I will upload it so you can watch it as much as you want to watch it, okay? Then, so on gold, now let's take a look at, you can see how gold has been heavily bullish. In this particular point, our monthly daily range is going to span from these lows all the way to the open highs. In short, the highs is even open. All right. And one thing about gold is, let's go down to the daily time frame now and see how we can utilize these opportunities, right? So in this particular case, seeing that we are trading at new highs, majority of the times, that 50% monthly daily range will not make sense to use. You want to just trade strictly the daily time frame structures. So if you follow the daily time frame structure here, you realize that, okay, price is bullish. Here, we got this bullish price action from here. Higher highs, higher lows, higher highs, higher lows, higher highs. Immediately, we got a break. What did you start seeing? 3 days of bearish price movement. Then they broke structure again to the upside and came back all the way to the downside, broke structure again. And as it stands now, see something that you should now understand in structure here, in the market structure here. Turning to line chart, let's study structure. See gold market structure here. Higher highs, higher lows, higher highs, the broke structure here, right? So this is our lower lows, our lower highs, our lower lows. Let me now see this. Did we close below this low here? Good. Like I told you, no matter how small, it is very significant. So we had lower lows, price broke structure again to the upside, but then quickly they disrespected these lows again that led to that break. So now we are bearish, and they created a new lower lows for us, a lower highs, a lower lows, and they've broken structure. Now we are bullish. Higher highs, higher lows, higher highs. They broke structure to the downside. We are bearish at this particular point, and now we've gotten a new break. So we are bullish. That's just it. This is how I'm going to continue changing my bias until, you know, a particular dealing range on the monthly time frame is cleared. So in this case, bullish bias is all that matters the most to me, that we are bullish. Bullish bias is all that matters. So our trading range now on gold is going to span from these lows all the way to these highs, and we should see some retracement to resume bullish price action on gold. Now, I know that in a particular position, just like what happened on gold here and what happened on GBP USD in the examples we took, you can see that there is a possibility to have up to 3 break of structures at a particular range. So in this particular range, just between these lows and these highs, we got a break to the downside here, instantly a break to the upside, instantly a break to the back to the upside, downside here, and immediately they broke back again to the upside, broke to the downside, broke again to the upside, having 1, 2, 3, 4, 5, 6, about 6 break of structures within this particular range. So now, how do you now utilize this break of structure? How do we now learn this break of structure and use it very well? That, okay, in so much that we have a bias, how do we save ourselves from some things that might appear to be a fake break of structure? That is what we're going to be looking at tomorrow. Now, you remember in our classes, I told you guys that this is our course outline, right, for the bootcamp. And today we're talking about building bias, which is the monthly, daily ranges, daily trading ranges. Tomorrow we're going to be talking about the quarter point theory And I will now be teaching you about my daily range cycle, which is my DROC concept for identifying trading opportunities. Now, if you come to this, look at where quarter point theory is now going to help you refine some of those things very, very well. In quarter point theory, one sure fact is this, is that price travels from zones to zones. And no matter how you see it, you will always realize that in the movement of this, you can see we navigated price from this particular zone. The next trading target will be this easy zone, this easy level. They came right into this level. Let me go down to the 4 hours time frame for more clarity. So this is more like a teaser against what you should see tomorrow in tomorrow's class, okay? So you can see how price has been reacting from levels to levels, from one level to another level, from this level. Immediately they blasted off, we got to this level. You can see how the interaction with price points within these levels are, okay? So now, how do you just use it? Some persons call them psychological levels, but to me, they are beyond psychological levels. They are quarter point theories, and I'm going to explain what they are by tomorrow, how to plot those levels, and the basics of my trading concept is support and resistance, but in a refined way, right? So I'm going to be teaching you how to read these levels to be able to utilize your daily time frame ranges and make some informed trading decision. Like I said, it is a process. You will not learn every single thing in one day, right? We are still talking about solidifying the aspect of building a bias. And I think to a great extent, I've been able to do justice to that particular topic. When we now come tomorrow, we'll talk about quarter point theory, my daily range cycle concept. And after that, we'll now proceed to talk about points of interest, momentum, and my entry system. There you will now, on the day 5, we'll put every single thing together and do a proper analysis on as many assets as we can. All right, we'll study as many assets as we can, even if it is 2-3 assets, we'll put all these things together. Monthly daily range, quarter point theory, entries, our points of interest, the momentum consent, and then entries and how we can utilize those particular opportunities or bring all these things together to make an informed trading decisions. So as for now, just keep this at the back of your mind when it comes to building a bias, all right? So go back to your chart, study these things. In any asset, like I said, you'll be able to see these things clearly, all right? In any asset. I would just want to take one more asset and then we'll call it a day. And I'm looking for a random asset here. Let's see GBP AUD. I don't know what we have there. And let's just cut any part on GBP AUD. I don't know what price must have done below there. So let's cut. So it's not look as if, as you can see, I don't know what price has done below. So let me cut and then we go below and see what price has done there. I've not traded GBP AUD before. And so I cannot really tell. But then it's a proper analysis we're doing right here now, okay? So based on this, you can see that our most recent trading range is going to span from these lows to these highs, right? Coming down to the daily time frame, what do we want to do? Trade in the direction of the daily time frame until you see a counter break. So now let's see this direction of the daily time frame. Something fishy is going on here, but then let us turn to line charts for clarity. So we got higher highs, higher lows, and a new higher high was formed here that led to this break of structure. And price is creating lows, lower highs, and a new lower low. So before we can say that we are turning bullish, is only when we see a break here. Ideally, we want to just be looking for only bearish opportunities. So our bias is what? Bearish on GBP AUD. And one of the easiest targets we should see is that we should see price come to the 50% fib levels, right? So having said that, we're back to candlestick chart. So we want to see continuous bearish price movement until a daily break. If no daily break present before this 50%, just know that one of the easiest targets we'll get is that 50% bias until we see a counter break of structure. Now let's see what price did here. Can you see how the bearish bias has been respected? And now can you see something very much interesting here? Did you know somebody would actually see these highs, lows, and see this new range that was formed here, turning to line charts now, and actually be seeing these highs as an internal liquidity for what? And this is how you would have actually missed out on a good trade opportunity, not knowing that, okay, A new highs, a new lows, lower highs, lower lows. So we are continuing bearish until we see a break here. So far, this break did not happen here. We should continue seeing bearish price action. All right. Now, we want to continue selling this range until we see a counter break. If no counter break, our bias remains bearish. Okay. So having said that, let's see how far these sales happened. Okay, no, we didn't get that to the 50%. We got a break. Automatically, our bias is no longer bearish. In short, at the end of this particular day, you will know that your bias is not bearish. All you want to be looking out for is only bullish bias. How do you now engage in those trades? Instantly. Oh, sorry. I didn't want to press that. I wanted us to flow with this. So instantly they came back down, gave us another break. So now we are bearish, lower lows, lower highs, lower lows. They ranged for a whole lot of days before they gave us this break. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and so on and so forth. Okay, you can see how the bullish bias continued their move. All right. And like I said, nothing is 100%. But once you can identify this 80 to 90% of the time, if not 95% of the time, your bias will be correct. It's just your ability to be flexible. That once I see that daily break, my bias is changing. All right. I'm no longer bearish, I'm bullish. Or I'm going to hold on to my bearish bias until I see a counter bullish break. As simple as that. So it's just following the daily time frame structure. It speaks a whole lot of volume. The daily time frame speaks a whole lot. And once you can play with that, you'll be able to utilize the opportunities that will be presented to you on that. Okay. So I don't know if anybody have a question. You can signify, I can unmute you. I will allow you to unmute yourself, and then you can unmute yourself, ask your questions, we address that. If no questions, we'll call it a day. And tomorrow we'll now dive deeper into my concepts. We'll now look at the quarter point theory. I will now teach you my daily range cycle concept, one of the sweetest concepts out there that you can use with my quarter point theory concept, or not my quarter point theory. I'm not the founder of quarter point theory. I learned it too. Okay, just as you are learning here too, I learned it and it has been useful to me. So tomorrow we'll be diving deep into quarter point theory and my daily range cycle concept. And that one, I'm the one that got that out of study. So I will teach you guys how to now utilize it. All right, with what we've learned also, because, okay, fine, I have a bias. How do I take the trades with the bias? Like I told you guys, once you build the bias, the next thing is points of interest. So the purpose of the daily range cycle and the quarter point theory is to help you get points of interest. After points of interest, you want to talk about the precision in the execution. Then on day 4, we will now be talking about our entry system and our entry model with the momentum and the rest of all those things. Day 5, we put it all together, talk about risk management and psychology, and you will see how you can properly utilize these opportunities to make an informed trading decisions. Okay? So having said that, thank you all for making our time to be on this call. I believe you've gotten one or two values. With the absence of any other question, we'll call it a night.